Okay, in this video we are going to look at structured credit risk, and the topics that we are going to cover here is the types of structured product, capital structure and structurization, waterfall, participant, securitization, simulation, probability of default, implied correlation and default sensitivities. So structured product, capital structure and securitization, structured product, participants, a basic waterfall structure and the impact of correlation should be studied to correctly gauge the risk that we have in the structured product. What we need to understand here are qualitative impacts of changing default probability and default correlation for all tranches, for mean risk, and the mean is the average and risk is the credit war. Default sensitivities, which are similar to DV01, are things that we need to look at, and the process to compute correlation extracted from observable market prices. So there has been a general trend in the FRM here is to really go to some of the risks that are very pertinent, like the correlation between various tranches. Many of these things are quite tricky to get from the open source stuff. And the other thing that I like about the changes that they have made is that they'll talk about deducing these parameters from market prices. You know, because each of the time you can use your old model, but since we have got many things from the market, it's all the time better to deduce things from the market prices. So market prices should always be considered, correlation with market prices should be considered, and things like that. So let's understand what are the types of structured product. Now, common types of structured product and the various dimensions are important to calculate their value and structure. Securitization and structured products are two types of most important financial innovations in recent times. Securitization is basically the pooling of credit sensitive asset and the associated creation of new securities. A structured product or portfolio credit products are those whose cash flow are based on underlying loans or credit claim. Each product has its own risk and return characteristic, which can vary dramatically from the original asset. So there are many structured product discussed here, and they are covered bonds, mortgage pass-through securities, collateralized mortgage obligation, structured credit product, asset-backed securities. So these are something that we'll look into one by one quickly. So covered bonds are on the balance sheet securities. A pool of mortgages which secure a bond is separated from the loan into a covered pool in the originator's balance sheet. The investors have higher priority than general creditor if the bank defaults. Principal and interest are paid and guaranteed by the originator. It is not backed on the performance of the underlying asset themselves. Thus, covered bonds are not true securitized since the assets are not a part of bankruptcy remote structure, and the investor can have recourse against the originator. So they are not true securitization. Then we have the mortgage pass-through securities. In contrast to covered bond, mortgage pass-through securities are true off-sheet securitization. They are important one, true off-sheet. There are some rules for that we studied. So investor receive cash flow based entirely on the performance of the pool less the fees. Most mortgage pass-through are agency-backed securities that carry implicit or explicit government guarantee. If you remember Freddie Mac and Fannie Mac, thus default risk is not a serious concern. The primary risk is due to prepayment of principal, most likely for refinancing after interest rate declines in a home sale. So that's one type that you need to understand. Then we have collateralized mortgage obligation. So CMOs are MBS that tranches, that is divide cash flows into different securities based on predetermined condition. The resulting tranches have long or short maturities, fixed or floating cash flow or other condition. The most basic structure is the waterfall sequentially pay structure, where tranche receives all payments and portion of interest is each period until it is paid off. The remaining tranches will receive interest until tranche A is retired, and then the principal will flow down to tranche 2. Not surprisingly, tranche A will have low prepayment rates as opposed to all prepaid payments. Then we have structured credit portfolio. Like other structured product, the pool of assets is backed by risky debt securities. The difference is that structured credit portfolio create tranches that have different amount of risk. The most junior equity tranche will bear the first loss and most likely return of the default. If the equity tranche is completely wiped out, the next junior tranche will bear the credit risk of the subsequent default. The most senior tranche will have highest credit rating and the lowest probability of write-downs. Then we have asset-backed securities. This is the most general class of securitization where cash flow generating assets are pooled and sequentially tranched. Under this definition, MBS is a special case or more general of ABS. Other varieties include collateralized bond obligation, debt obligation, loan obligation, and collateralized mortgage obligation. There exist even more complex securities that are pooled, such as CDO square, which is CDO of a CDO. Structured credit products can also vary across the dimension. First, the underlying collateral of the pool can consist of loan, bonds, credit receivable, auto loans, and non-debt instrument that generate cash flow such as toll collection. Secondly, size and number of tranches specified to each transaction. Thirdly, pool can passive or active manage. In passive mode, the existing assets such as mortgage, auto will eventually pay themselves. On the other hand, in managed pool, will selectively add or shred asset. Manager will be key insight, should be able to enhance the performance of pool and overvalued and undervalued loan products. Revolving pool have a period of time when loan person invest into new assets. So those were the type of securities. Now let's understand the capital structure and the securitization process. Now the role of capital structure and credit losses in a securitization process is very important to consider. The capital structure of securitization refers to a priority assigned to different tranches. The senior tranches is at the top and will have highest priority to receive payments, and they are the safest, but they have the lowest coupon. The equity tranche is the slice of the cash flow distributed with lowest priority, absorbing first loss, and they don't carry a fixed coupon but receive residual cash flow after the others are claimed. Therefore, return is variable, hence the term equity. Equity is the smallest part of the capital structure. Between senior and equity, there are mezzanine, also known as junior, and to securitize variable, mezzanine tranches will be purposefully thin. There are many creative ways to provide credit protection to various security classes, but this must come at the expense of shifting risk to other parts of the capital structure. In general, credit enhancements can be divided into internal and external. The term external credit enhancement means that credit protection take the form of insurance or wrap purchases from a third party, typically a monoline insurer. So just remember this thing, the monoline insurer who gave protection to these bonds, and when we looked at it again, we saw that in the external credit enhancement and the insurance. Two types of internal credit enhancement are over-collateralization, excess spread. Over-collateralization is when the pool offers claim for less than the amount of collateral. For example, consider a collateralization. So this is internal MBS with 100 on one mortgage, but the face value is only 100 mortgage. Over-collateralization is hard credit enhancement because the protection is available at the originator of the pool. The excess spread is the difference between cash flow and the payment made to borrower. For example, if the weighted average collateral is 8% net of fees and weighted average of the payment promised in a senior junior tranche equity tranche is 7%, then the residual 1% accumulates in separate trust. The excess spread will be invested and available to make up for the future shortfall. Since the excess spread is zero at origination, it is considered soft credit enhancement. So excess spread, just before that we looked at excess collateralization. Now we have the express spread, which is the difference between cash flow collected and the payment made to the bondholder. So if the weighted average of the collateral is 8% net of fees and the weighted average of payments promised is 7%, then the residual 1% is accumulated in the account. So this is then invested. Now let's look at waterfall structure. Evaluating waterfall structure with multiple tranches become very important, and waterfall structure outlines the rules and conditions that govern distribution of collateral different branches. Simple example, securitization, the juniors will receive promised coupon on sufficient amount of cash inflow from the underlying loans. The residual cash flow, if any, is called the excess spread. The over-collateralization trickle will decide how the excess divided between equity. Intuitively, the underlying cash flow will be largest in the earlier product and will be built up against a future shortfall. In practice, this process can be quite complex and maybe dozen tranches or more with different coupon maturities. So if we analyze a cash flow in waterfall structure by considering, suppose we have 1000 identical loans which 1 million each. The interest rate is LIBOR plus 300. The senior junior tranche are 80, 50 and 5% of the pool. The spread of the senior and mezzanine on 1% and 5%. There is one over collateralization trigger where equity holders are entitled as of a maximum 15 million and excess cash diverted to excess trust account. So assuming default, the cash flow of the waterfall structure. So loan dollar value of identical loan, principal amount, LIBOR, spread, coupon, and over collateralized trigger. Then we'll make the tranches, which is LIBOR, spread, and so coupon, and coupon of mezzanine, equity 5%, and the rest of it is paid off. So we'll find out what money we are going to get. So we are going to get LIBOR plus spread, and that money we'll have to distribute. So we'll get 8%, we'll distribute 6% to 80% of senior. The coupon rate for the lowest guys are 10%. So that would be that, and interest then the interest the remaining one would be sent to trust after paying the equity holder. So this is how they would create the waterfall structure. Now things might become complex when they use over collateralization, and they also use a default rate of 4%. So when that happens, we need to divide the money, we need to subtract the default, and then we have to pay the promised coupon to the senior, to the mezzanine, to the equity, and the remaining to the trust. So securitization participation. So nature of securitization process from original loan to tranche necessarily involves many different participants. The first step begins with originator, who funds the loan. The originator may be bank, mortgage lender, financial intermediary. The term sponsor may be used if originator supplies most of the collateral for the issue. The underwriter provides a similar function to issuance of debt and equity. The underwriter structures the security, engineers the tranches, coupon, and sends it to the investor. The underlying warehouse is the collateral and faces the risk. The issue will be marked, or the collateral value will drop. The credit rating agencies are important part of securitization process. Without their explicit approval via credit rating, the investors would serve disadvantage to asset the riskiest of issue. The credit rating can influence the size of the tranching. In addition, creditor may influence the issuer by requiring enhancement. There is a natural conflict of interest because the CRA want to generate profit and grow their business, but it may become at the excess of a larger portion of capital structure to lower interest rates in investors. Investor can alleviate their concern by performing their cost analysis. The role of servicer is multifaceted, possibly understated. Servicer must collect, distribute the collateral and associated fee. In addition, servicer may need to provide liquidity if payments are late. It is hard to envision a conflict of interest or foreclosure. The servicer, all else equal, like to delay foreclosure to increase their fees. So when the pool is actively managed, another source of conflict arises. The manager naturally like to minimize the effort to continuously monitor credit quality. A common feature of securitization pool is for originator manager to bear the first loss on the capital structure. So the next topic is three-tier structure, and one or two iterations of interim cash flow in a three-tier structure, including a final cash flow to each tranche holder. So that's what we are required. So the cash flow in three-tier structure, which is senior mezzanine equity, can be broken into inflows from collateral and outflows to investor. The inflows prior to the maturity, interest on the collateral plus recovery from the sale or default assets, assuming collateral partners and individual, and coupon, LIBOR plus spread. The term cash flow in the final year are last interest payment plus principal and recovery of defaulted assets. As an additional consideration, the recovery funds from the funds would earn interest over the minimum pool at rate R. The outflows are coupon payments paid to senior mezzanine note holders, collectively known as B. Assume constant. The equity holder is a bit more complicated because the excess spread has the first priority on cash flow to provide soft credit arrangement to more senior tranches. Especially if the equity holder flows are dependent on the amount of inflows to the pool, the funds are diverted to express spread account, denoting. So just the same thing, that pay the senior, pay the junior, but equity has got a maxima. So when the maxima is touched, then we'll divert everything to the fund where we'll store the express spread. So that is the excess spread account. So that was it. And now we move to the next topic, which is simulation approach. Describe a simulation approach to calculate credit losses for different tranches in securitization. So the prior analysis made a very few important simplifying assumptions. In particular, the analysis assumed that the default rate was constant. Each loan exhibited the same default probability and correlation between the loans were ignored. In reality, however, these assumptions need to be brought into analysis. The only tractable way is to do that by simulation. Although the technical details we are not going to look at, but we need to understand the parameters, the default time simulation, compute portfolio credit losses. So first we should look at the critical parameters default necessary pairwise correlation. The default intensity can be estimated using market spread to infer the hazard rate across various maturities. This piecewise boosts methodology to construct cumulative default rate. We already looked at that. Then we estimate correlation between the various tranches or the loans. Now, there is no lack of data and we use the copula correlation, but this suffers from an empirical precision practice, and this is very tricky and unreliable. So instead, a sensitive analysis is performed for various default and correlation pair. Then the next step identifies if the security default simulation provides information about timing of each hypothetical outcome. The third step uses simulation approach to define the frequency and timing of credit losses. The credit losses can be linked up to access the impact of capital structure or the tail distribution to identify the creditor for each securitization. So we now move to the next heading, again a very qualitative area, which is the impact of probability of default and default correlation. So the probability of default and default correlation among the underlying asset of securitization affects value, losses and creditor of equity junior and senior tranches. Now there are very simple comparative statistics associated with general securitization. The following reasons represent the effect of average tranche including write-downs. The implication of extreme tail event will be something that we have to calculate using VAR. The first step to consider is the probability of default. The straightforward to see for a given correlation, increasing the probability of default will negatively impact on the cash flow and thus the value of all the tranches. The effect of changing correlation is more subtle. Consider the Sterling case where the correlation is low, say 0. So loan performance is independent. Therefore, in large portfolio, it is virtually impossible for none of the loans to default, and is equally unlikely that there will be large number of default. Rather, number of default will be very close to the probability of default time. So the pool would experience a level of defaults very close to its mathematical expression and is unlikely to impair the senior tranches. Now, contrary to this, if we look at a case to understand this case, so if we flip a coin 1000 times, the number of heads would be close to 500, and it would be virtually impossible for the number of heads to be less than 400 or greater than 600. Now, if the correlation increases, the default of one credit increases the likelihood of another default. Thus, increasing correlation decreases the value of senior tranches because they are more likely to suffer extreme losses. This effect is exacerbated with higher default probability. Now, consider equity tranche, and we see that equity tranche suffers from the first write down. Therefore, a low correlation implies predictable but positive number of defaults. In turn, equity tranche will assuredly suffer write downs. On the other hand, if the correlation increases, the behavior of pool is more extreme, and there may be high levels of related loss, or there may be low loan loss. In sum, the equity tranche increases in value by increasing correlation as a possible 0. The correlation effects on mezzanine is more complex when default rates are low. Increasing the correlation increases likelihood of losses to junior tranche and senior tranche. However, when default rates are relatively high, increasing the correlation actually decreases the expected loss to mezzanine bonds, as possibility of few defaults is now more likely. Accordingly, mezzanine bond mimics the return pattern of equity tranche. In short, increasing correlation at low default rate increases mezzanine bond, but a high default it will increase. So the increasing correlation at low default rate decreases the size, but high default rate and correlation it will increase the mezzanine bond value. This is a little bit tricky here. So the one thing that seems strange that you need to look at is that increasing correlation at a high default rate will increase the value. So that's where it's a little tricky and unintuitive. So convexity is another issue for default rate. For equity investor, default rate increases from low level the equity tranche value decreases rapidly then moderately. Since equity tranches is thin, small changes in default rate will disproportionately impact bond prices at first. Similarly, senior tranches exhibit negative convexity. A default increases, the decline in bond price increases. As usual, the mezzanine impact is somewhere in between, negatively correlated at low default rate, positive convexity at high default rate. So the correlation is quite tricky to understand, and now we move on to focus on the average mean of values of tranches and examine the distribution of possible risk. So we want to analyze the impact of default probability and default correlation under extreme condition, far off into the tail. The metric used is credit score for various ranges and default probability, default correlation for junior, equity and senior tranches. The main result is that increases default probability while holding correlation constant generally decreases the VAR. So VAR for the equity tranches, less variation, and increases the VAR for the senior tranches. Okay, as usual, the mezzanine effect is mixed. So let's look at it one more time. So increasing default probability while holding correlation constant decreases value at risk for equity tranches. So if there is increasing default probability but the correlation is not increasing, then this will decrease the value at risk for equity tranches, which means there are less variation in nature. One thing we need to understand here is that although we expect default and we plan equity tranche according to that and we give them some excess return, but that would be trickier when the correlation increases. So increasing default probability while holding correlation generally decreases VAR for equity tranches or less variation in return, and increases the VAR for senior tranches. So increasing default probability will increase the VAR for senior tranches. Now, as usual, the mezzanine is mixed. VAR increases at a low default level and decreases at a high default level. So at low level it behaves like a senior bond. So VAR increases, but at high default rate it's like equity. So whenever we want to look at mezzanine, always behaves as both of the others. The next effect is to consider the impact of rising correlation. So increasing correlation increases the clustering of event, either high frequency of default or low frequency of default. So if one is not defaulting, other is also not defaulting. If one is defaulting, other is defaulting. Increasing correlation decreases senior bond prices. So when you increase the correlation, the price of senior bond decreases as the subordination is more likely to breach if defaults happens in cluster. In contrast, equity return increases as low default is more probably due to low correlation where default are almost certain. So in equity the returns increase as low default scenario would keep again low. So equity returns increase as low default scenario is more probable and relative to low correlation where defaults are almost certain. So if they are not defaulting, nobody would default, and that would benefit the equity holders. So all else equal, the senior VAR also increases consistently with correlation. However, we note that all interest effect, the increment difference between high correlation 0.6 0.9 is relatively small. In addition, two pairwise results are worthwhile highlighting. If correlation is low and default frequency is high, then senior bonds are very well insulated. In fact, at 10% subordination, the senior bond would be unaffected even at high default rate. At one extreme, when correlation are high, 0.6 or above, VARs are quite similar regardless of default probability. Hence, generally speaking, correlation is more important risk factor than default probability, which may not be entirely intuitive. So the whole idea here is to re-emphasize the importance of correlation, because in general we'll observe that nothing would happen, and if a high correlation is there, then nothing would happen. Is correlated with other nothing to happen, means there are more chances of nothing to happen. and that's how the logic gets built up here. So let's move to the next part, which is measuring default sensitivities, and this would be like the third last topic here. So the effect of increasing the probability of default, which decreases the tranche value. However, the effect is not necessarily linear and also depends on interaction with default correlation. To analyze marginal effect in more detail, we define what is dv01, and it is the extended default probability and is called default 01. The default probability will be shocked up and down by the same amount by convention of 10 basis point, and each tranche will be revalued through war simulation. The formulation of default 01 of each tranche is calculated as 1 by 20 into mean value upon loss value on pi plus 0.001 minus mean value upon loss value on pi minus 0.001. I think this pi represents the probability, and we find out the mean value upon the loss value on probability of 99.9%. So there are several qualitative effects here. So the first is default sensitivities are always positive for default probability correlation combination. So and default 01 will approach 0 as default rates become sufficiently high, as marginal impact of increasing the default rate has minimum effect. So there will be some variation in the default sensitivities when default rate generates loss close to tranches attachment point. So this is a little tricky and not much has been given here, but I'll again try to emphasize the important point here. So the default probability will be shocked up and down by the same amount, which is by convention 10 basis point, and each tranche will be revalued through the war simulation. The formulation of default war or the default 01 of each tranche. So we'll calculate mean value upon loss value at 10 basis point movement, and we'll divide that by 20. So don't worry if you don't get this, you can just leave it for the time being. Then we have the risk for structured product. So there are different type of risk that plays a role in structured product. So aside for credit portfolio modeling issues discussed before, there are at least 3 other risks, which is systematic, trenching thickness, and loan granularity. So similar to the well-diversified equity portfolio that cannot eliminate systematic risk, the same holds here for credit portfolio. So when the collateral pool is well diversified among lenders, term, geography, other factors, high systematic risk and high correlation can severely damage a portfolio. As previously discussed, with increase in pairwise correlation, likelihood of senior tranche write down increases as well. The equity mezzanine tranches are relatively thin. This manifests itself into relative closeness of 99%. What the implication is that given that the tranche has been breached, the loss likely is very large. Loan granularity refers to the loan level diversification. For example, in collateralization MBS pool, the portfolio comprises of few loans are of substantial size. This reduction in sample size increases the probability of tail event in relation to equal size portfolio construct with more loan of smaller amount. So there were 3 points of types of risk: systematic risk, tranche thickness, and loan granularity. Now the equity, I'm repeating one more time the same thing. So in the well diversified equity portfolio that cannot eliminate systematic risk, the same hold true for credit portfolio. So unfortunately, even when the collateral pool is well diversified among lenders, geography, other factors, high systematic expression and high correlation can still severely damage. As previously we have talked about, with increase in pairwise correlation, the likelihood of senior tranche write down increases as well. Now we move to the trenching part. So equity and mezzanine tranches are relatively thin. This also manifests itself in the relatively closeness of the 95-99% wall. The implication is that given that trench has been breached, the loss is more likely. So the bigger trench is having more thickness, and the equity and mezzanine are very small, so the chances of breaching are high. Then we move to the implied correlation and understand how it could be measured. So implied correlation is very similar concept to implied volatility of equity option. For options, Black-Scholes model is widely accepted. So observable market is associated with unique observed volatility. For securitized tranche process, exactly the same. Starting with observable market prices, for pricing a function of tranches, it is possible to back out the unique implied correlation to calibrate model market price. The mechanical part of the process involves several intermediate steps. The first observable default swap term structure is used to extract risk-neutral default probabilities and possibly recovery rates, assuming pairwise correlation from the market prices. For respective tranches, the default estimate coefficient can be fed up into a copula. The output is a risk-neutral implied correlation or the base correlation per tranche. The correlation will vary between the tranches and are not likely to be constant, giving rise to correlation skew. As an example, suppose observable market price of an equity tranche from 3 to 3.2, but the estimation of risk neutral probability remains the same. This infers that the market estimate that the implied correlation must have increased. This precise value must be expressed for pricing model, but qualitatively direction is correct. Increased correlation benefits equity holder. So we now move to the motivation for structured products. Now, identifying the motivation of loan originator investor can provide a better understanding of why securitization was established. Loan originator who helped to create securitization by selling loan into a trust are attached to borrowing via securitization given to the ability of lower cost of funding. Without securitization, loan would be either retained or sold in secondary market. This alternative would more likely cost than funding via securitization. A lower cost of funding can be obtained given the diversification of the loan. However, the same loan, such as commercial mortgage, can be very difficult to diversify. This element of systematic risk exists, which could lead to underestimation of overall risk. Investors who purchase asset securitization are attracted investing into diversified loan products. They would not do otherwise have access without securitization. And the ability to select desired risk level return while tranching another advantage. Equity tranche will offer highest risk return, while the senior tranche will have lower risk return. However, it is important for us to conduct proper due diligence while they do that. So I'll quickly go through all the points that we have discussed till now, and then we can end this one. So I'll summarize all the points and I'll start from the last topic. So the implied default correlation for each tranche can be backed out of the tranche pricing model, similar to how implied mortality was calculated for Black-Scholes model. Similar to equity portfolio, systematic risk is present in credit portfolio. Extreme loss events are captured by high default correlation. The thinness of equity and mezzanine tranche implied that the conditional loss are likely to be large. Less granular pool, fewer loans is more likely to expel tail event, all said equal. Default sensitivities are measured analogically by DV01 and spread 01 by shocking the default probability up and down. The default sensitivities always play positive and are larger when resulting loss is close to attachment point. Increasing default probability will increase all tranches unconditionally. In contrast, increasing correlation will impact each tranche differently. So in general, increasing default correlation increases likelihood of extreme behavior. So credit war can be used to measure value at risk in the left tail. Increasing the probability of default increases war for all tranches. In contrast, increasing the correlation decreases value at risk of equity and increases value of risk at senior, and this is the exam question for sure. Simulation is always useful to provide more insight in the performance of collateral and cash flows to tranche. In particular, the default intensity can be time varying and estimated using hazard risk distribution. The correlation between loan is critical to performance of pool, so various default probability correlation are used. Copulas used to simulate the timing of default. Finally, simulation allow computation war for each tranche. So that was it for the topic here, and we'll end the structured credit risk. This is a new topic added this time in the FRM part 2, and I'll catch you in the next session. Thank you for listening. I hope this added something new to your existing knowledge base.